and welcome to our live Buy-to-Let What's Next webinar in association with Landbay. As England and slowly the rest of the United Kingdom gradually ease lockdown rules, uncertainty still remains over the true impact of, amongst other things, the extension of mortgage and loan payment holidays, house prices, and the return of higher LTV products in both the buy-to-let and mainstream markets. Indeed, what's the future for funding for non-bank lenders, the general economic outlook, and now a real possibility of negative interest rates? To discuss this and more, and hopefully answer some of your questions, I'm joined today by Landbay Chief Executive John Goodall and Landbay Chairman and mortgage funding expert Tony Ward. Good afternoon to you both, and thank you for joining me. Now, this is a live broadcast, and we will be taking some live questions. If you do submit a question that is not answered, the team at Mortgage Introducer will, along with our panelists, seek to get it answered privately, if not on the Mortgage Introducer website itself. But to start us off, just last week, Andrew Bailey, the Governor of the Bank of England, refused to rule out cutting interest rates to 0 or below in response to the coronavirus economic crisis. Now, they've backtracked slightly on this, but Tony, it would appear nothing's off the table. What would such a move mean to the UK mortgage market, current products, and indeed, what would it mean for the position of non-bank lenders such as yourselves?
Yeah, well, thanks, Robyn. I think, first of all, you have to understand what will happen to back books of lenders. And most mortgage lenders have floors, that's spelled F-L-O-O-R, by the way, floors in their mortgage conditions that state that mortgage rates can't go below a certain level, regardless of what happens to underlying interest rates. And I think for Landbay, that's 10 basis points, so we'll never go below that. So I suppose that's the first thing, is they're not going to go negative for by far the majority of market, regardless of what the Bank of England does. So question is that fair? And what's the point of negative interest rates anyway? So I think you have to understand that the key point of this is all about stimulating the wider economy. So what the Bank of England doesn't want is banks and building societies keeping cash with them when they'd rather it's put into the economy to keep the economy going. So what you do is you make interest rates go negative, and effectively it's a charge that says you can keep it with us, but every day it's with us, we're going to charge you money. So it forces banks and building societies to deploy their money and lend, which is what the Bank of England would want to do. It's all about stimulating the market. But so that's the mechanism, that's what it's there for. What does it mean for lenders? Does it mean, therefore, that if interest rates go negative, that their cost of funds go negative? And the answer is no. Even if you're a bank or a building society and you use retail funding, it's unlikely that you're going to be passing on negative interest rates to depositors, because you'll lose all your funding, or you'll risk losing your funding if you start charging depositors to keep money there. So you're likely to have a level of positive rates that you pay to depositors in any event. The second thing is, what about wholesale funded lenders like Landbay? Landbay eventually funds its mortgages through securitization, issuing bonds, and you're not going to get bond investors investing for a negative yield. So the cost of funds is not going to go negative. It's going to stay positive for everyone. It's just banks and building societies may be coerced effectively by the Bank of England to deploying money into the wider market. Quick point though, I suppose, is have we ever seen negative interest rates before? Yeah, we have. We've seen it in Japan. Actually, last year, not COVID-19 related, the Danish introduced last August, Jyske Bank launched a negative interest rate mortgage that I think it was -0.5%. But borrowers didn't get paid they weren't paid 0.5% to take out this loan. The negative interest rate was used to pay down the loan early. And I think it was probably a bit of a misnomer, not done the maths, but I suspect if you look at the costs and the fees of the thing, it wasn't a negative interest rate deal at all. So all in all, they're never going to go below a certain floor. Virtually the whole market will have floors set into their mortgage conditions. Cost of funds will not go negative for anyone, but it is a stimulus to banks to deploy their cash. That's really what it's there for.
Okay,
yeah.
well, wait. Go on, John.
Yeah, and it's worth pointing out, in terms of real interest rates, they've been negative for most of the last 11 years. So I think it's February or March 2009 when the Bank of England cut rates to below 1%, and they've stayed below 1% ever since. For most of that period at 0.5%, and obviously now at 10 basis points, whereas inflation has been at, in most of that period, again, 2 to 2.5%, has occasionally gone below that. So we've had negative real interest rates, and we've lived with them for the last 15 years. And if you think, even if it only, for the accumulation at 10 years, if you put in £1,000 into your savings account, it has eroded over the course of 10 years quite significantly in value anyway.
No, well, whatever happens with interest rates, Chancellor Rishi Sunak is already on record saying that the country is facing a severe recession, the likes of which we haven't seen before. What's your take on this? And should brokers and our viewers, and what should they be doing to prepare for the inevitable? Now, is there a silver lining to this? And I've got a question from Rob Jupp, Chief Executive of Brightstar, who wants to know what shape you think the economic recovery will take. Will that be V, W, U, or L-shaped? John, you got any thoughts on?
Yeah, I mean, the first thing I'll point out is this recession is very, very different to other ones that either we've lived through or recent history. Most of the historic ones have come about because of asset price inflation or monetary policy or bubbles occurring somewhere in the economy, etc. And this actually has more to do with the sort of recessions that countries experience, or certainly Western European countries experienced hundreds of years ago, that were linked to broadly the sort of natural events, where a bad harvest would mean that the country enters a recession because the agricultural segment of the economy was the majority of the economy, and that hasn't been the case in the UK since the Industrial Revolution. So this sort of act of God type recession, which we're experiencing now, is more similar to that, and so that does mean, while it's quite severe, there is that possibility that we do get out of it quicker. That if coronavirus, if the pandemic stops at some point, whether it just burns itself out or a vaccine or a cure, then as soon as confidence returns, the market should return to normal. And again, I don't think it's going to be quite a V. I don't think it's going to be an L whatsoever. I mean, I heard someone mention something the other day that they thought it was going to be a Nike swoosh recovery, which I think is probably the most likely outcome. But we get a second wave, then anything could happen. I mean, I think there are so many different scenarios that could happen, and we don't know. But there probably is a base case scenario that we do see a meaningful recovery, probably over 2021 rather than 2020.
Yeah. So I'm probably I'm less optimistic than John. That's probably my role. First of all, I think it's very easy to look at this as just as a COVID-19 problem. It isn't. So if you looked at world economies before this all happened, back to late last summer, actually there was pressure on economies and banking markets even then. Do you remember things like oil price going through the floor, and also the trade disputes with China? So we had China, Russia, the US all in standoffs over oil prices, trade wars, and so on. So we already saw liquidity squeezes on banks that were nothing to do with COVID-19, and all of that's still there. And we've also got the US and China quite hard to see exactly what's happening in that economy, but the economy is slowing up. The US is slowing up. So it is going to take longer to get out of, I think, than people are thinking. So I can't see that we're going to have a sudden rebound when we all go back to work and it's all going to be over. And I actually don't think John's saying it's all going to be fixed as we come back to work. So this is going to be a long, slow slog out of this, in my view, where we always see markets overreact on the downside and the upside. So when we see the economy go back to work, there'll be a bit of euphoria. Markets will probably overdo the upside bounce, and then they'll go on to a more normalized growth out of it, which I think is going to be long and slow. So if it's a Nike swoosh, it's going to be quite a low Nike swoosh for recovery, in my view. I hope I'm wrong.
Well, we shall see.
Yeah.
When we first went into lockdown and the market ground to a halt, one of the main bugbears for all brokers was valuations and lack of. Now, the market has since opened up, and there is still a massive backlog of surveying and valuation work in the pipeline, and thankfully it's being worked through. Now that physical valuations have started again, though, how trustworthy are they, given that various market experts are predicting house prices to fall anywhere between 5% to 30% in the next 3 years?
Yeah, so I'm happy to have a go at that one. I think, again, I think a lot of lenders during lockdown went into using remote valuations and AVMs and then put load to value caps in. So they said for lower risk loans, we're prepared to rely on an AVM. Now, I think AVMs in this market are quite difficult things to use because they are effectively based largely on historical data. And guess what? We've had a big gap in historical data for the last 2 or 3 months. We haven't really had any. So that's the first thing. The second is they're trying to calculate a valuation based on historical data, not so good at forecasting cliff edges. So I'm not saying I'm not forecasting a cliff edge, but if there was one ahead of us, an AVM probably wouldn't spot it. So I'm not discounting AVMs, they're useful, but they're quite hard in these quite difficult markets. So I think it was great when either there were remote valuation tools available and now some return to physical valuations. I think the problem, and I pity in a way, I sympathize with the valuers because they know that house prices are likely to go down. They just don't know, as nobody knows, by how much and for how long, and which ones are going to be affected the worst, because it's too early to tell. So what would they do? They're likely to overcook it. So we will see valuations on the downside, probably, because they're at risk. And so I think we all have to understand and sympathize with the fact that they're giving an opinion, which if it's wrong, 3, 4, 5 years down the line, they could be sued for that opinion, for losses covered because they overvalued. So they're almost certainly going to be doing the opposite, which is downvaluing. And this has happened before as we've come out of recessions, happened 92, 93. We saw it again as we came out of the credit crisis. So it's normal to be expected until there's some better understanding of what is happening to property prices than we can really know now. What we know now is that there are downside risks and there's potential down valuation. It is too early to determine too much. I would say, final comments on this, I suppose, from me though, were talking to various colleagues in the industry who are saying, yeah, it's probably only going to be a 3 to 5% fall in house prices across the UK. I'd be surprised if that was the case. That will be a very anodyne reduction in house prices. So I don't know what it's going to be, but I suspect it's going to be more than that, would be my view. John's probably got a better, more upbeat view than that.
Valuers will be cautious, and obviously there will be as you rightly said, there'll be a backlog. It'll take time to get things through, because something that's also worth pointing out is valuers have got to obviously get access to the property, and in most cases the tenant is going to be sitting in the property at home, which wouldn't be the case, and potentially working from home as well. So it will take longer to book valuations as well, and I think that has to be taken into consideration just to get access, if nothing else. Once we start seeing some transactions go through on vanilla properties, and it doesn't matter therefore whether they're residential or buy-to-let properties, that can be either, and they've got some transaction pricing, that is going to help. And from what I hear and read, there's quite a lot of transactions that have been put on pause on sort of the home loan market that should feed through. So that does give a bit of a benchmark. So I think they will be cautious until we see more data there. But I do think it's on that side of it, people finding what that new normal is in terms of house prices. It shouldn't be too long. It's not saying I don't disagree with Tony. I'm not saying house prices are going to stay flat or they're not going to go down, but they'll get a better sense of where they are, and that might be different in different regions and different types of properties. I think where it's harder is some of the more unique to buy-to-let properties where, large HMOs, MUFBs, maybe some properties above commercial, etc., where there's going to be less transactions. You're typically looking at them on an investment valuation, and there'll be far fewer transactions there. And I think on those ones in particular, we'll see some problems. Not that problems are the wrong word, but see even more caution. And certainly from a lender's point of view, you're not typically seeing products in those markets kind of come back as quickly as you are on the vanilla properties.
Yeah, and the other thing is what we've also seen is lenders. So as lenders have got more comfortable, either AVMs or using a combination of AVMs, remote desktops, initially those were used only for sort of 75% LTV max. But we've seen those lenders pushing those up, not just with physical valuations, but with remote valuations, because in the last 8 weeks, a lot of things have moved on in valuation technology in response to COVID-19, which will help lenders sort of understand the risk even without being able to send in a physical value, people like CoreLogic, for example, amongst others. And in addition to that, there have been insurance solutions. So lenders can take out insurance, even if it's a virtual or remote valuation, that's given them confidence to actually increase the LTVs on these loans. So lending was getting back to normal even before the physical valuations really starting again, from my perspective.
It's interesting. On to a question from Ian Balfour from the Finance. And speaking of we both think how long it will take to get back to what he calls a normal market, and whether you think the government will do anything more to stimulate that market. Do you have any thoughts on government intervention? Any further government intervention? Tony,
well, I'll do the first bit on normal market. I think what we're seeing, not just in the mortgage market, but with the broader economy, is there's not going to be a moment where I think we suddenly sit there and say, right, we're back to normal. In the same way that the lockdown is gradually easing, and it probably will do over the course of, I don't know, 5-6 month period. The same is sort of panning out in the mortgage industry, where you can see slightly high LTV, slightly criteria being loosened on a daily or weekly basis by different lenders. And it's going to take quite a while, I think, for us to get back to where we were in February from a mortgage market perspective. And that's the same as the economy. And it comes down to the things that will really get the market back to normal is when people don't have to socially distance anymore, where colleagues can sit next to each other in an office a metre apart, or however close it is, and they can travel on a tube. And I think whenever you've got those issues around working in not just offices, but working in factories, and people having to use public transport, it becomes very difficult to see a normal, and likewise go to a pub and go to a cinema and a football match or wherever it might be. The economy is not going to get fully back to normal until we can do those things. And I think the mortgage market will sort of follow in the same footsteps. In terms of government intervention, I mean, I can't remember when we've had any more government intervention than now. I mean, obviously the furlough scheme, the payment holidays, TFS, the bond buying program. So I think the government is doing quite a lot. I'd be surprised if they can do any more, to be honest.
Yeah, I tend to agree with that. There's huge amounts out there. There are always areas where maybe segments of the market think they could do more, but I suppose some sympathy for the Treasury and the Bank of England in particular, that they've got a lot of demands on them at the moment. They have to look at these, assess, they have to triage them effectively and assess whether they're vital and systemically important for the economy. And they have to get to that conclusion pretty quickly to decide whether they're going to plug another hole, as it were. So right now, I think they're probably drawing breath from what they've done and probably think they've done enough. But if they see more gaps opening up, maybe they'll do some more. But it's not obvious that it's needed right now.
James Murray from MT Polo, he's suggested that we might see some changes to the tax relief available for landlords as a result of COVID-19. Would that help the situation, do you think? Yeah,
but I suspect that's not going to happen. So things like stamp duty or tax relief, the 3% surcharge on stamp duty and the tax relief reversals, I can't see that happening. I mean, with 300 billion cost of COVID-19 support, the government is, unless, again, it's a systemically important thing to do because of a structural stimulation to the buy-to-let market, I don't think they're going to do anything that cuts off revenue to the exchequer. John, what do you think?
No, I agree. I think the exception could be if they really want to give the economy a kick, but that's not going to be by stimulating the buy-to-let mortgage market. We saw in the financial crisis, they did actually reduce stamp duty for a window across the board. So I think if they do that, they may do that for certain properties to try and stimulate some transactions. Obviously, the government then also reduced VAT for a period. You might see things like that. So you may see some. Only tax cuts I think we're going to get are ones that are going to directly and very quickly get the economy moving again. And while obviously buy-to-let tax relief for buy-to-let landlords would be a positive for buy-to-let landlords, it's unlikely to fulfil that requirement to give the economy a boost, I'm afraid.
So moving back to LTVs, we've had a couple of questions come in on LTVs. Perveen Manurahan, he wants to know if physical valuations have been given the go-ahead for loans at 75%. And Michael Nichols from Focus Mortgage Services wants to know how likely it is that LTV values will go back up to 80%. And Tracy Whiteside from Independent Mortgage Advice Centre wants to know if we'll see a return to 75% on buy-to-let anytime soon. And Gary Thomas is another broker wanting a return for high LTV lending. John, what's the state of play at Landbay at the moment?
Well, as of today, we're still at 60%, but watch this space. I think we will see some movement quite soon on that, and a reversion to somewhere close to where we were before the lockdown. Certainly, I think from what my understanding, we are, from a valuations point of view, in terms of that first part of that question, valuations are going out at 75%. Valuers, there are other lenders that have that product. Said, I don't think we're too far away from that point. 80%, we'll see. It's not on our radar at the moment. I don't think in our space, in terms of specialist lenders, anyone's gone there yet. I may have missed something, but I haven't seen any of our competitors bring out an 80% product yet. But then obviously on the owner-occupied market, we're seeing a return to higher LTV lending, 90% or so. So you may see it back not soon, at some point. I mean, to be honest, particularly with the stress tests and the ICRs, I speak for most of lenders here, that we didn't really do that much business on an 80% product. It was maybe 3% of our book, maybe even less than that. So the core market is at that 75, 70, maybe 65% LTV. So I think the 80% will take a little bit longer.
Yeah. I think we have to remember, sorry, I was going to say, I think we have to remember as well that the response to lenders to cutting back on LTV, a lot of it was we're still in the backwash of the onset of lockdown and what it meant. So it caught people out, and suddenly they were having to move all their processes remotely, take staff out, mitigate costs, protect capital liquidity of banks, deal with new rules coming out, the FCA and PRA on payment holidays, all of these things. And at the same time, you couldn't do physical valuations. And guess what? Lenders cut back on LTV, partly because they didn't quite know where the risk was. So why actually take higher risks until you can see the land clear? Partly as a mechanism to choke off some volume. But I think you're seeing that easing again now, because lenders are becoming more comfortable that they can see some sort of positive green shoots coming out. The horizon is more positive. And actually, we have to have overcome working from home and dealing with payment holiday issues and so on.
Ian Balfour's just been back in touch, and he just wants to know, as a follow-up, should lenders, landlords and funders be looking long-term in buy-to-let? And does that need a new outlook by all in the new normal?
Yeah, I think absolutely right. So the buy-to-let market is sort of bifurcated between the amateur landlord and the so-called professional landlord, which tends to be the Landbay sector, and particularly with portfolio landlords. And my view is that these landlords, by and large, they're taking a medium to long-term view. So they wouldn't be making their minds up right now, this is all bad news, I'm going to exit and dump my entire portfolio. So this is one of the problems that the buy-to-let market has suffered from the Bank of England. In Mark Carney's term there, certainly, and the Financial Policy Committee, they deemed that the buy-to-let market was riskier than the owner-occupied market. Well, there isn't any evidence to support that in terms of losses or arrears over its 25 years history in the UK. So, and in my view, it tends to operate counter-cyclically. When things go bad in the economy, in the residential market, you need a private rental sector to support it. So I would say it works as a counter-cyclical risk buffer against the owner-occupied market. So I think the portfolio landlords, the professionals, the semi-professionals, they know that. They're in it for the long term. They may be rejigging their portfolios, working out which ones they need to have less of or more of, and they'll be looking for opportunities to go and buy, as maybe some of the shorter term players do exit the market. But I think the fears from the Financial Policy Committee is this is a sort of situation where you see a mass dumping of assets, which pushes down house prices. I don't think that's going to happen. I don't think that was ever going to happen. And I think medium to long term is the view that the pros and the semi-professionals will be looking to.
Yeah, I agree with Tony. I think it was going that way anyway, particularly since the stamp duty changes and the change in tax relief, particularly that's the growing segment of the market. And attached to that, I mean, increasingly over the last 2 to 3 years, because of the PRA changes, but also because of pricing, I think as well, the 5-year, the percentage of 5-year products on buy-to-let have increased. So landlords and lenders and brokers are taking a sort of longer-term view on financing as well, typically.
Well, speaking of long term, RBS is forecasting a fall in home ownership due to coronavirus, and that renters aged 35 to 44 will outnumber mortgage holders by 2029. Now, obviously, neither of you can comment from an RBS point of view, but what are your thoughts on that? Surely this is good news for the buy-to-let market going forward.
Well, I do think there's a number of things at play here where lenders may reduce their risk appetite at the home loan market for first-time buyers. They may put in higher affordability tests, particularly with certain workers like contractors and self-employed, and want a longer track record of earnings, etc. So you can see how home ownership becomes harder to some degree, and therefore people that's going to have an impact on the rental market, i.e. more people needing or wanting to rent, whatever the case. So I think that is likely. I think the other point as well is once we are through this period, one thing that quantitative easing typically does is it pushes up asset prices. And so if the economy recovers and the government's been pumping in lots of money to keep interest low, it is likely to have a push up the price of all assets, and that includes property. We saw it in 2010, we saw it in 2011, particularly in the southeast, where property inflation was hitting sort of 15, maybe 20% a year in some cases. Now, I'm not predicting they go back to that level, but if that is the case again, if once you get through fully the economic impact of the recession, you could then see a return to house price inflation based on the quantitative easing aspect of it as well, particularly if interest rates are maintained low, because there will be a search for yield.
Well, house prices, we have had a few questions on house prices. Drawn to one here from John Masters from Atwoods, GCS Financial Services, who says, with the doubt hanging over house prices and such high purchasing costs, where are the opportunities for anyone wanting to get into the buy-to-let market at the moment? Can you see opportunities out there?
I'm not an expert on that. John, do you have a view?
If you take a long-term view, and you see the rental market holding up or increasing in importance over the next 5 to 10 years, then yes, there probably is opportunity to buy right now, because house prices are probably slightly deflated. You may have a problem renting it out in the first year, etc., etc. But in a long-term view, then yes, there are definitely opportunities. But again, it does depend on your risk appetite, and there's probably a bit of trouble in the short term, or uncertainty in the short term. And we certainly saw that again in 2009, 2010. Professional landlords were typically buying properties. Now, what we don't know, and this is the harder bit to gauge, is despite 2008, 2009 being a financial crisis where London, the banking sector, was immediately the bit that was most impacted by it. Interestingly, when you look at the recovery, it was London that benefited the most. Actually, house prices went up, and actually the rest of the economy took far, far longer. Now, some of that was down to the government's response to it and austerity, etc., etc. And I think the government's response will be very different this time. Now, what we don't know is there going to be a change in the market? Are people going to work from home more? Are people think, well, actually, I don't want to commute anymore. I'm going to, work more days from home, and therefore I don't need a property in London. I'm prepared to travel in. And again, there have been some questions posed on the student HMO market, and then suddenly you think, well, actually, are universities going to change with online learning, et cetera, et cetera? So there could be a lot of change in the housing market because of this, or equally viable, as often happens, we might just all return to normal in 8 to 18 months, and we're still getting the tube or train into London.
Yeah, I think there are opportunities there. John Scally, he wants to know, well, he says thinking about sub-segments of the buy-to-let market, landlord type, tenant type, property type, business or personal, in the context of the COVID pandemic, which do you think will contract, stall or grow? Do you have any thoughts on that? Surely it's a bit pie in the sky at the moment, is it not?
I think it is very hard to predict at the moment, but I think the obvious one that people are looking at is, and hopefully it's just a short term, i.e. up to 12 months problems, is the student lets. Now we've had universities announcing that they're effectively closed and will work virtually. But my daughter's been at home finishing her 4-year master's degree for the last 3 months from here. So that looks as if it's set for quite a lot of student communities for the next 12 months. Is that going to be long term? I don't think so. So it means uncertainty and pain for those landlords for the next 12 months, how to deal with this if they haven't let those properties. But I suspect that's not going to be a long term thing.
What are your thoughts on the...
I think on the first part of that question, I do think, which I suppose is a continuation of the previous question in terms of landlord type, I do think the professional segment is going to be a far faster growing segment of the market than even it was pre-COVID-19, because you could see now that it's not just the financing, that when you've got tenants, if you see tenants arrears spiking and you've got issues with managing a property, when there's a lot more complication now, because actually you've got to go in and socially distance, and you've got to think through potentially further health measures in a property, particularly managing an HMO. Is an amateur landlord going to want to do that? Is it harder work to be a landlord over the next year post-COVID-19? I suspect it is, and therefore I think that will deter amateur landlords even more than potentially the tax changes did.
What are your general thoughts on the HMO market as it is? There's a question here from Tiffany Ching, and there's a couple more in the Q&A box as well. Given it's much harder to value these properties at the moment, and lenders have really restricted lending. So is there a future for the HMO market in this COVID territory?
Yeah, I think as property types, very much so still. I think there is this problem now, which largely is around valuations, particularly for the larger HMOs. I think it's less of an issue where properties are up to 5 or 6 and you can value it like on a bricks and mortar basis, like a house. But I think as a part of the housing mix, they're very, very important. But there is going to be this problem around valuations for the short to medium term over getting access to large HMOs and actually thinking about investment type. And again, as Tony said, that student issue where what happens in September and October, is there going to be a wave of defaults or students not paying their rents in September, October, that then feeds through either in landlords defaulting on mortgages or requesting payment holidays in mass.
Also, I see someone else has asked a question about travel industry and free fall. Are Brits going to be staying here rather than travelling abroad? And therefore, what about the growth in the holiday let type things and Airbnbs? I think with those, the student lets, HMOs more generally, I think the next 12 months we're potentially going to see a lot of disruption. But I don't believe those are going to be long-term measures. I think right now people don't want to travel on a tube train if you can avoid it. Is that still going to be the same in a year? I suspect not. We're going to get more comfortable of going back traveling abroad and going in an aircraft, assuming there are some aircraft still around to fly in. So I think the next 12 months we should not read in necessarily what we can see immediately in front of us with some obvious problems like HMOs and travel problems and student lets, we shouldn't read that in as being a long-term change to the market, I don't think.
Okay, well, we've talked a little bit about working from home. I've got a question from Ray Bolger, and he says, with the exception of a long-term move to more home working and less commuting to a city centre office, do you expect city centre apartment blocks to underperform as an investment over the next few years? John, what are your thoughts on?
Well, so I'm again, it's only a view, it's a personal view, and I know there's a range of opinions. I personally don't think there is going to be this structural shift. I think there will be a return to normal at some point, and people aren't going to suddenly think, well, actually, I'm going to work from home for the rest of my life. I think a lot of people like going to the office. They like the social aspect of it as well. So I'm not sure about the premise of the question for the market as a whole. There's going to be exceptions, but I think in 2 years from now, I think people will still be going to offices. I think the interesting thing is actually potentially the opposite of potentially what Ray mentioned is if that is true, where people aren't going to the offices, well, actually, then you don't need offices, and there's a big market in turning office block commercial into resi. So actually, you might bizarrely see a revival of the housing market in town centres as office blocks suddenly become flats again.
Yeah, and we have to see. So personally, I'm probably likely to spend much more time working from home in the long term, but I don't count myself as necessarily typical. So what I do miss is camaraderie and ability to bounce ideas off people in a way that Zoom and phone calls just doesn't substitute for. So I don't think people are going to. We're suddenly going to see the whole market working from home. Sure, there's a cost saving. Cost saving in time. And when I commute to London, it's 4.5 hours of my day gone going there and back. It's fantastic. I've got all that back. It saves money, but you lose something as well. I think you lose the ability to innovate quite so quickly, collective bouncing ideas off people. So I'm certainly a couple of months or so into this, I'm missing not being in London and seeing people. And I suspect I'm not alone in that. So how's that going to impact though? I suppose the other thing is I was reading, I think it was in the Sunday Times this weekend, about people who have both a place in the country and a place in London. Maybe they're going to switch them around and base themselves in the country with a smaller pied-à-terre in London. And maybe we'll see that. Who knows?
Well, Samuel Daly from Spencer James Financial, he was the one that was asking about the increase in Airbnb. He also wants to know, with lenders forced to make key staff members work from home and creating alternative working practices, will this potentially become the industry standard and create a new norm where better services provided through greater efficiency for your clients over the longer term? John, what's the situation with Landbay? Are you going to continue having a lot of your staff working from home?
Well, no, I suspect long term, the default option will be working from the office for us. In vast majority of cases, there may be some exceptions. Relies on Tony. We do a lot of teamwork. It's harder. Does that mean we become slightly more flexible than we might have been in February? Or potentially we will do. But I think the default is going to be that when we can safely do it, and again, the vast majority of people. For us, we're based in Victoria, so people rely on public transport, and so we'll probably be. It'll probably take us longer to get fully back to the office than a place where people can say drive to work. Obviously, a number of people do cycle to work, but on the main, people are taking trains, buses, and tubes, and that does create a problem. But I suspect we will end up getting the vast majority of employees back to work, but it will take a bit of time.
I also think as well, if you look at regulated businesses as well, it is harder to comply with all the rules. Like, for example, call recording remotely and stuff, and being able to do that as seamlessly as you can do if you're doing it from one central place with all your sort of infrastructure around it. So I certainly know early in lockdown, a number of reasonably significant lenders had a lot of problems in just being able to work from home with the lack of technology and so on. So I think everyone's got there now, but it's not ideal, I wouldn't say. So
okay,
carry on.
Moving on. Well, so far, nearly 2 million people have taken up mortgage payment holidays. with many more taking holidays for credit cards as well as personal loans. What are your thoughts on this payment holiday and obviously them now being allowed to extend that for a further 3 months? Some things to consider. Have these payment holidays been a good thing, or are they really just a disaster in waiting and preventing the inevitable? Andrew O'Neill from Ideal Mortgage Advisors wants to know whether taking a payment holiday will have an impact on an applicant's credit score. Still a lot of confusion over this. John, what do you think?
So firstly, do I think they've been a good thing? I think it's very good that the government was wanting to ensure that renters were not going to get kicked out of their houses, and that's the purpose of payment holiday. The payment holiday is there to help the tenants, help the renters, so they can have security about where they're living during the period of crisis. So the aim of it was right, but what they did, I think, was pass it on to the landlords, not without the tenant really being involved. Now, it might have been quite hard to pass it on to the tenant, and it might have been an easy way to implement it, but it hasn't been ideal. We know that the level of payments in buy-to-let, we know that a lot of the payment holiday requests, or the level of payment holiday requests, have far exceeded the number of tenancies who are defaulting or struggling with their rent, because in many cases the furlough scheme has helped tenants on the main to ensure that they've still got money coming in to pay their rent. So we have seen it used, to quite an extent by landlords to buffer their cash surpluses, and obviously therefore, and it has put a cost on banks and non-bank lenders. I mean, this is interest revenue that banks and non-bank lenders are foregoing or receiving further, or capitalising, or whatever it might be, and so this is one of the few government schemes where the government is not actually paying for it. The government has sort of introduced a scheme and said, right, you just take the hit. Whereas every other government scheme, the Bank of England or Treasury is writing out a cheque. On this one, it's not. It's being pushed over to the lenders, and often with very little consultation. So I think it has caused problems. So in terms of the second part of the question, how do we view an applicant who's had a payment holiday? First of all, it doesn't appear on the credit score, so it's not a credit issue in that sense. It won't affect their credit score. Let's talk about it being identified, but not as a non-payment, etc. And I think the credit rating agencies are still working on some of that. But at our time, what people understand is, when you're asking a payment holiday, you are effectively saying, I cannot afford to pay for the mortgage right now. And so if we've had instances where last month a landlord was having payment holidays on his whole portfolio of properties, and then he's applying for another mortgage now, on one hand he's telling us he or she that he's financially distressed, and on the other hand he's saying, I'm creditworthy. And you have to then therefore ask, well, actually, as a prudent lender, should we be lending more money to someone that's already saying to us that they cannot afford to pay their mortgage?
Absolutely. And we've also seen the industry has been different parts of the industry have implemented this in very different ways. So I know in Landbay, when someone asks for a payment holiday, we investigate why they want a payment holiday, because it might not be in their best interests to have one. Because I think for some individuals, they don't understand this is not a free gift. This is actually money they've still got to pay back, and actually it's going to cost them money because they get charged interest if it gets added to the account. So it isn't always in their interest. So I know Landbay has taken each case, looked at it, and talked it through with the customer as to whether it's the right thing for him. My view, and based on what I've seen and heard elsewhere in the market, other lenders have not necessarily done that. A number, I suspect, have done it almost on the basis that it's a right of the customer, that he's asked for it. It's almost like a self-cert, and it's been implemented. So across the industry, you're going to see huge variances between small proportions of the book that have got payment holidays and significant amounts. And I think it's public information. I think one savings bank came out and said 26.7% of their book was on payment holidays. I think probably about a month ago, they made it as a stock exchange announcement, which seemed to be a reasonably larger amount in my view. I'm sure they're not the highest. So big ranges, but now this scheme's been extended. It'll be interesting to see what happens next, because are we going to see across the whole of the industry payment holidays move up to, I don't know, 30% of all mortgages outstanding and loans outstanding? Or are lenders actually going to be much smarter or interrogative of the customer as to why do you want it? Is it in your best interest? I'm torn. I'm not quite sure which way it's going to go at the moment. But,
yeah, and I think there's another point that particularly borrowers who are sitting on, say, 75% LTV mortgages right now, or even below that, mid-70s, who have typically added fees to their mortgage, which may be 1%, 1.5%, or whatever. So they're actually slightly over 75. If the interest they're paying on it is 3.5% for 6 months, they're then adding another, 1.75, call it another 1.5. So they could be then sitting at 78% LTV. That's on the price of the property at the time they borrowed it. Even a relatively small adjustment in property prices, 3 or 4%, pushes them over 80%. And then they're in a scenario where, as I said, in our space, I don't think there's any lender who's over 75%, let alone over 80%. Let's say some lenders get there to 80%. It's going to be expensive. Let's be honest. The differential between 75 and 80 is going to be expensive. So you're creating scenarios where, by allowing them to capitalize it, they could end up being mortgage prisoners and then being stuck on their reversion rates with their current lenders, and reversion rates are typically, 200 basis points higher, maybe more than their current rate. So it's not always just kicking the can down the road, thinking I'll add it to the loan, may cause problems a year or two's time when they try to remortgage it if the property market hasn't recovered.
Do you think some landlords have been gaming the use of payment holidays? I've heard a couple of stories of some using the money that they can save on their portfolio to put towards a new acquisition. That's something you've seen?
Well, I can't comment whether we've seen it or not. I suspect that has happened. We've had some cases where we have had that instance where we've had borrowers who've got loans with us, who've got requested a payment holiday while an application was in flight. And then when we've told them then we're going to have to turn down this application, suddenly they don't need the payment holiday and they found the cash to pay it. So, I think there have been obviously some cases. And as I said, my understanding from the data I've seen is the level of payment holiday requests or holidays granted, not just requested, is far higher than that of tenant forbearance.
Yeah, I think that's absolutely right. And it's just possible that some aren't gaming the system. They think it's badly described. It's a payment holiday. They get off paying their mortgage for 3 months, which is not the case. This is why I think it's really important to for each application for this, you talk it through with the customer as to why is it that you want it, what's caused it, do you know this is actually going to cost you more money in the longer term, and you're going to have to pay it back, and it may not be the best thing for you, which I know Landbay does.
I'll come on to a potential name change in the next question. Ron Abram from Abram Lawless Financial Services, and this is still to do with payment holidays, says that with payment holidays you've been forced to offer, even where the applicant doesn't appear to need it, that must be reducing your working capital considerably, not just you, but for all lenders, and even for those lenders which are well capitalised. To what extent does this funding shortfall directly impact your lending, and how quickly can you expect HM government to cover the promised funds to you to cover these capitalised payments? And also on the name change, he just says, should we be calling these something other than payment holidays, as it conveys the totally wrong thought in the minds of some? Maybe something like coronavirus capitalised payments instead.
Yeah, a payment deferral would be more. I agree on that final point. In relation to ours, we don't lend our own money. We lend funders' money, and we lend on behalf of other people effectively. And so it doesn't impact us directly, but obviously our funders are taking that cash hit. They're comfortable to grant payment holidays and carry on funding. But certainly, I think it is quite a meaningful amount of interest that is being deferred, and it will be having an impact on lenders' ability to lend. So I think that is. I think that is definitely the case. Was there a middle question there? I think I asked the first one and the third one, but did I miss?
as you've been forced to take payment holidays, has it had an impact on the funds that you can lend out as Landbay?
Okay, no, not for us. No, that has never. So I think the bit I didn't mention was, are the government going to cough up for it? There have been numerous attempts to try and encourage the government to help lenders cover some or these costs, or in some capacity. To my knowledge, while the government or the authorities have listened, there has been and understand the problem. There hasn't been any guidance or indication that they'll be helping us.
Yeah, so that's absolutely right. So one thing I would say, though, is for people looking at wholesale funded lenders like Landbay and securitized markets, it raises some questions about, well, is this a reliable funding source then, if for these types of things? I would say we talked earlier about low interest rates or negative interest rates. One of the things we have to reflect on in the world, this is not just a UK thing, is there are investors that need to invest in something to get a positive rate of return. And I would automatically think of life and pension funds. And if we're going to see gilts with a negative yield, deposits with zero interest rates, actually investing in mortgage-backed bonds of one sort or another, or even in whole loan portfolios of mortgages, pretty good thing. Positive rate of return and secured. So I would say it's caused an extra stress to the wholesale funding markets that had not been anticipated, this payment holiday, because we've never seen anything like it before, and it was just imposed without consultation. So it was unhelpful, but understandable why it went in so quickly. The Treasury felt they needed to react very quickly. However, I think long term, the investors, they'll stick with this, and I think long term, they're still going to be around to invest in mortgages, either securitized or whole loans.
Do you think we'll see more product innovation on that front then, in terms of making products more attractive to investors, or indeed making mortgages more attractive to landlords?
I think we will see innovation coming out of this, a bit like wars, isn't it? Where wars forces innovation. So I mentioned earlier, we've seen innovation with property valuations in the last 8 weeks, significant innovation there. There are other mortgage innovations in the pipeline, like first-time buyer products and so on. And I think that this will catapult some of these into place. And by the way, I don't think those innovations will come out of the larger lenders. So again, linked to predominantly specialist and wholesale funded lenders. In history, in the mortgage market, that tends to be where the innovation arises. It doesn't come out of the large systemic banks, because it doesn't really suit their wholesale industrialized models. So I think we will see it, and we'll see it either from existing specialist lenders like Landbay and others. But there are others out there that I think are working on plans that COVID-19 doesn't sort of kill. If anything, it's going to stimulate some of them, I reckon.
You mentioned about the securitization market before. A question from Simon Allen from Searchlight Finance. He wants to know whether you think lenders should publicise on their intermediary sites how they are funded and how reliant they are on the securitization market. He says for him, lenders cancelling cases post-valuation and increasing pricing on cases submitted doesn't give him the confidence to use them in the future. How's Landbay on that? Are you quite transparent?
I think we are actually, but I mean, we're slightly different where, and just to correct Tony, is actually the majority of our loans are not securitized. They're sitting on banks' balance sheets. So, but we actually lend on behalf of banks. So some are though. So we have different funding mixes, and it's worth pointing out that banks do securitize as well. I mean, certainly Precise Mortgages, obviously, which is part of a bank, one savings bank, and before that, Charter Court has been one of the most prolific securitizers, as has Paragon. So it's not necessarily the case that non-bank lenders securitize and banks don't. So lenders often use multiple sources of funding, and we as a non-bank use bank funding and non-bank funding. And I think we do make it clear how we're funded. And an impact on the securitization markets does impact banks as well, and you can see that in our space where banks have increased rates as well. And they, the way that the banks in our space, special lenders, have acted has broadly been speaking very similar to how the non-bank lenders have acted.
Yeah.
Okay. Now, after the global financial crisis in 2008, all those in financial circles were speculating what the new normal is going to look like. Now, they're all doing it again, but this time it's not just financial circles. Everyone, who is everyone, wants to know what the new normal is going to be. Now, if you both have a crystal ball, how do you see this panning out? Can you see a return to normality, as we sort of mentioned before? What do you think that's actually going to look like? Can you see a return to mass gatherings? Lots of awards on the horizon coming up. Will they even take place? Who knows? What do you think? John, any ideas?
So I think we will return to normal, and it will be quite similar to how it was in February. And I certainly hope, Robyn, the Mortgage Institute Awards in December are taking place, because we've won Biotech Lender for the last 2 years. So it'd be nice to get the 3 in a row. But I do think they will. Things like obviously concerts, say public transport, football, and I'm following obviously the return of the football season. I'm quite intrigued to see how that pans out. But it looks like probably for 6-9 months there's not going to be anyone going to stadiums there. So I think those mass gatherings are going to take time, but I think we will get there. I think it's not going to be this year for those mass gatherings, but I think I hope in summer next year, people are going to Glastonbury, cricket's on, football's on, people are jetting off on holidays, etc., etc. And I think we will. The time frame I'm less confident on, but I do think as restrictions are eased and people get more comfortable, and hopefully COVID-19 is no longer with us, we can go back to normal and people doing all those things that they enjoy doing.
I'd say if you look at it, look at the global economies really. Unlike 2007, 2008, this was a global financial crisis, came out of credit crisis, poor lending, and then led to a liquidity crisis. That's not where this was, although, as I said earlier, there were some problems in the US and China ahead of this. But overwhelmingly, this is to do with COVID-19. And early focus, really, the last few weeks, was how do we stop deaths and how do we stop the NHS falling over? That was really where the focus was. That's now moved. We've moved, sometimes not being handled brilliantly, but it's now moved to how do we stop this economy tanking and live to fight another day? So it's all about stimulating the economy and getting back to some sort of normal. When that is, the government will want that as soon as possible. So they'll be balancing the risks of more deaths and that spiking again and having a longer term negative impact. But as soon as they can, they want this economy back on track and working healthily, with people confident that they can go to work and go and meet and socialize and travel and spend money in restaurants and theatres. So we have to get there. Otherwise, we can't carry on the way we are, stating the obvious. How long it's going to take, it's too early to say with any great conviction, but it looks like we're on the way. And looking at Andy Haldane from the Bank of England, he's certainly in the last 24 hours made some much more positive comments about the impact on the economy and downturn being less severe than they had thought at this time. So let's hope Andy Haldane is right. He seems to be a pretty smart guy, in my view. Well,
it is a global situation, and looking at Europe, everything is moving at a different pace. Each country has their own set of regulations, lockdown rules. I've got a specific question from Albert Trucks, and it's for you, Tony, and he wants to know what's happening in the Dutch buy-to-let sector and whether there could be any opportunities for either investors, brokers, and indeed lenders.
Yeah, well, if Albert's watching, hi Albert. Yeah, so wearing another hat, I have a business Fortune which operates predominantly in the Dutch mortgage market and specifically in the Dutch buy-to-let market. And I suppose just quickly, why is it relevant? Well, if you look at the Netherlands, they are so similar to the UK in many, many ways. They have a housing shortage. They have a London and Southeast problem, which for them is called the Randstad area, which is Amsterdam, Rotterdam, and Utrecht. Their house prices in those areas tend to perform like another economy, just like London and the Southeast does here. They have long-term fixed rate mortgages, which we don't tend to have here. They have an active broker market that's not dissimilar to ours. What they haven't had is, they haven't had Brexit interfering for the last few years. Remember Brexit? It was the thing that we spent all our time looking at until COVID-19 came along. So they haven't had that. Some would say they have handled things through COVID-19 somewhat better than the UK. So they don't have the economic and political risks that the UK had even before COVID-19. And they've actually started to pull out of it much quicker and going back to work. So I think as an economy, it will be one, if I was an investor, I'll be looking to the Dutch market. And if I was particularly interested in investing in mortgages, I'd be investing in the Dutch mortgage market because it's similar to the UK, but without some of these, as I say, political and economic downsides. The buy-to-let market there, by the way, it's about 4 years old as opposed to our 25-year-old market here. It's not at all dissimilar to our market. It's evolving fast, and it's using things like structured finance and pension funds, investing in whole loans to invest in it. So I would say for investors, it's a market you should look at. If you're familiar with the UK market, you would be easily able to get familiar with the Dutch market. So as an investor, also as a lender, and actually for brokers watching, why not look at that market as well? It's a fast evolving market that's easy to understand. I'm very positive about it.
Getting in there at the start, well, relatively start now, there could well be some opportunities there.
Yeah, and they've had the benefit of learning some of the lessons from the UK, because if you remember when we started in the UK buy-to-let market, it was Mortgage Trust where I was CEO, and Paragon when we were separate companies at that time. And we started this in 1995, 96. And we more or less had this market to ourselves at the time. We created the niche, and we did it because it wasn't being oversupplied by the big lenders. It was a really good risk. There was demand. You could get a positive margin. And then it was around about 2000 to 2007 that the large lenders came in, completely industrialized it, drove down margins, drove down credit standards, and so on. So we've been recovering from that post-credit crisis, and that's the onset of the specialist market rebuilding in the UK. The Dutch market has been able to look at what we did and hopefully not make those mistakes that we made.
Right, okay, fascinating. So I think we should all pop over to Amsterdam for a nice little weekend break when this is all over.
Two weeks in isolation when you get back there.
Absolutely. Well, thank you all. That does bring this special Mortgage Introducer webinar in association with Landbay to an end. Thank you to both John and Tony, and thank you at home for watching. You can watch this broadcast again via various social media and also on the Mortgage Introducer website, which can be found at www.mortgageintroducer.com. I'm Robyn Hall, Publishing Director of Mortgage Introducer. Thank you, keep well, stay alert, and stay safe. Goodbye.
Thank you.
Bye now.
Thanks a lot. Bye.
Bye.